If your accounting system is basically your bank balance, you may already be using single-entry bookkeeping. Picture a tiny business at the end of a busy day. The owner counts the cash drawer, checks the bank app, and notes what came in and what went out. That is single-entry accounting in its simplest form. Each transaction is recorded once, usually as cash received or cash paid. No complex ledgers. No balancing act. Just a straightforward record of money moving through the business. For a very small operation, that simplicity feels perfect. It is fast, easy to learn, and easy to maintain. If you only need to answer one question, how much cash do I have right now? Single entry can help. A solo freelancer, a weekend seller, or a tiny shop may use it to stay organized without getting overwhelmed. And at first, it seems to work. Cash comes in from a sale. Cash goes out for supplies. The owner writes it down. The numbers look neat. The process feels manageable. But this is where the story starts to change, because not every business transaction shows up as immediate cash. Here is the problem: a business is more than cash in and cash out. Suppose a customer buys today but pays later. In a single entry system, that sale may not appear until the money arrives. So revenue can look lower than it really is. The business earned the sale, but the record tells only part of the story. Now flip the situation. Imagine the business receives inventory, supplies, or services on credit. The expense is real, but the cash has not left yet. A simple cash record may ignore that cost for now, making profit look higher than it truly is. That is a dangerous kind of comfort. The same gap appears with assets. If the business buys equipment, furniture, or inventory with a large cash payment, a basic cash log may treat the entire amount like an expense. But economically, some of that spending may be an asset that will support the business for months or years. When those changes are not tracked properly, the numbers stop reflecting reality. And debts can disappear too. If the business owes a supplier, a lender, or a service provider, single entry often does not show that obligation clearly. That means the owner may know the cash balance, but not what is owed. And without a full record of assets and liabilities, there is no clear financial position. If you later need financing, that gap becomes obvious. A cash log rarely gives a lender the balance sheet style view they want. That is the central tension. Single entry is simple, but simplicity comes with blind spots. It can tell you what happened to cash. It cannot always tell you what the business truly earned, what it still owes, or what it actually owns. It does not have the built-in self-check that double-entry bookkeeping provides, where debits and credits must balance. So mistakes can hide longer, and missing transactions can go unnoticed. Incomplete records also make it easier for small errors, or missing transactions, to slip by unnoticed. For a tiny business, that may be enough for a while. But as soon as you start invoicing customers, buying on credit, carrying inventory, or managing employees, the gaps grow fast. What once felt simple can become incomplete. If you outgrow it, an accountant can sometimes reconstruct the missing pieces from bank records, invoices, and inventory counts. But that process is slow, and often approximate. That is why the question is not whether single entry is wrong. It is whether it is enough. For very small operations, maybe yes. For growing ones, usually not. So the lesson is simple. Single entry accounting is easy to begin with, but incomplete records limit clarity. It shows the surface. It misses the deeper story. It can help a very small business stay afloat. But it cannot fully explain profit, and it cannot fully show financial position. If you want to know what you earn, what you owe, and what you own, you need more than a cash log. Clarity starts with cash. Real understanding starts with everything else. Add those lists today, then move to double entry when transactions grow.